The downwards motion of oil prices seems to have been interrupted, yet the situation tends to remain fluid. Fundamentals related to the international oil market tend to be intense. In today's report, we are going to have a look at the data relating to the US oil market and continue to view the fundamentals affecting the demand side of the international oil market. To conclude the report, we will also provide a technical analysis of WTI's daily chart. There were some mixed signals regarding the US oil market over the past week. Starting with the Baker Hughes oil rig count, the indicator's reading last Friday showed that the number of active oil rigs in the US remained unchanged at 483. The release tended to imply the lack of need for US oil producers to activate additional oil rigs to pump out more oil. On Tuesday, we got the release of the API weekly crude oil inventories figure. The indicator reading was expected to show an increase of US oil inventories, yet that was not the case. The release tended to imply that demand in the US oil market surpassed production levels, thus allowing for the notion that the US oil market remains tight. The picture changed though on Wednesday as the EIA reported a slight increase of US oil inventories, implying that the tightness of the US oil market eased somewhat. Overall, should the signals in the coming week become clearer, possibly showing a tightening of the US oil market, we may see oil prices getting some support. On a fundamental level, we note that the southeast of the US have been hit by Hurricane Francine, now classified as a tropical storm. The tropical storm has hit Louisiana and is now turning northwards towards Mississippi. Heavy rain is now impacting a broad area, while a tornado watch is in effect for southern Alabama and western Florida. It should be noted that the wide areas have been flooded, while hundreds of thousands of homes and businesses experienced power cuts. The tropical storm is enhancing market worries for the possibility of a contraction of oil production levels in the US, which in turn could support oil prices. On the other hand, should market worries for the effects of the tropical storm starting to ease, we may see an adverse effect on oil prices. As for demand levels in the international oil market, the outlook is not so positive. OPEC has lowered its global oil demand growth expectations for 2024 and 2025. Similarly, also IEA cut its 2024 demand growth forecast. The agency in its monthly report cited that the chief driver of its downturn is rapidly slowing China. Overall, we note that the lowering of the oil demand outlook could weigh on oil prices. It should also be noted that the August manufacturing PMI figures tended to imply that Chinese factories are still struggling to keep economic activity afloat, which may enhance market worries for oil consumption in China and thus weigh on oil prices. Similar signals were sent for economic activity in the US manufacturing sector in the past month. WTI's price edged higher yesterday, bouncing on the 64.70 support line. We note that the commodities price in its upwards motion during today's Asian session seems to have broken the downwards trend line, guiding the commodities price action since the 30th of August. Hence, we tend to switch our bearish outlook in favor of a sideways motion for its time being, as the downwards motion of back gold's price action has been interrupted. Yet the RSI indicator, despite edging higher, remains close to the reading of 30, implying the presence of a bearish predisposition of the market for the commodities price action. For a bullish outlook, we would require WTI's price action to break the 68.00 resistance line and start aiming for the 71.15 resistance level. On the flip side, should the bears be able to regain the initiative over WTI's price action, we may see it breaking the 64.7 support line and aiming for the 61.50 support level. Those were the top financial stories for this hour. From all of us here at IronFX, we wish you a solid